Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. It's just past 12 noon Eastern Time. I also want to say, of course, good morning to those of you joining us from the Central Time Zones, Mountain Time Zones, and the Pacific Time Zones. Of course, we want to say good evening to any of you who are joining us from across the pond in parts of UK or parts of Europe. Well, welcome to today's presentation, tips on how to avoid being a victim of market indecision. Let's be honest, of course, one of the biggest dangers we face as investors is overtrading, maybe manipulating positions and putting positions in a situation where we're actually trading against ourselves, where we've put ourselves into a position where our expectations might be in one direction or the other, but the management technique that we chose actually puts us in a worse position based on that expectation. Well, once again, many of you are probably familiar with the concepts of radioactive trading. You've seen several blogs, maybe you've seen some slide shares, you've joined us for some of these other presentations. And you know that we look at a position, and when we open a radioactive trade, we're going to open every new position as a stock and put purchase combination that guarantees that we can't lose more than 4 to 6% on any one position. While we're holding the position, we'll be able to apply 12 different adjustments we call income methods to help us reduce the risk, generate income perhaps, and even bulletproof the position where we cancel all of the risk that we originally had. Now, for those of you that aren't familiar with radioactive trading, we're going to take 2 or 3 slides here very quickly, and we're just going to talk about what is the radioactive trading techniques. Well, these techniques were developed by Kurt Frankenberg about 15 years ago. After spending thousands of dollars to learn covered calls, spread trades, calendar spreads, and so forth, paying $3,500 for a weekend seminar and then maybe adding another $1,200 or $1,400 for trading services that were sponsored by the group that taught that seminar. Well, Kurt went out to put that into practice, and a few months into trading covered calls and so forth, he ended up losing all of the savings he had set aside just following his guru's advice. But he realized that the money that he lost doing covered calls and spread trades didn't just disappear. It went somewhere. So what he decided to do was develop a better way to trade in the markets. And what Kurt came up with, instead of doing a covered call position, of course, where the upside is capped, and you're still taking on 97 to 98% of the risk that you would have in owning the stock, he decided to find a way to flip that profit and loss chart. And what he came up with is a stock and put combination that follows the 3 core principles of any option trade. Now, for our example today, we're going to talk about positions. Let's look back on September 28th. We could use the numbers today as well. This presentation was designed last week, of course, but we could look at the numbers today. They're almost the same. But in any case, back on Wednesday, September 28th, I could have looked to purchase 100 shares of Apple at $113.95. To open a radioactive trade, I then would have also purchased one March 115 put at 8.15. My total invested now would have been 122.10. But we're guaranteed to get $115 back. When we purchase the put option, that gives us the right to sell to close our shares of stock at $115 at any time. So the maximum risk, the most I could lose, even if Apple fell down to $92 per share, $90 per share, would be $7.10 or 5.8%. A common risk-reward profile of the radioactive trade shows us a position where we have that very limited risk to the downside. And when we originally opened the position, we have unlimited potential upside profit. Now, on this particular risk-reward profile, what we see here on the curved red line is the profit and loss of this particular position on October 28th. We'll explain why that's important in a few moments. But because we purchased a put that was several months out in time, was slightly in the money, which follows the 3 core principles of radioactive trading, and really all trading, the put does not decay one-to-one with the stock. In fact, if the stock was at $115, just a point above where we might have opened it on September 28th, we would only have a loss of about 30 cents. We'd be pretty much close to break even. Now, we're not near that 122.10 yet, the total cost basis we had into the position. That's only true at expiration. If I held the position all the way to expiration and made no adjustments, and the stock was below 115, I would have lost that full 5.8%. But because the put does not decay one-to-one with the stock, we're pretty much close to break even 1 month into the trade, with the stock just moving a slight amount. Okay, and then we're going to look, of course, to apply different adjustments, what we call income methods, going forward. That's the basic structure of the radioactive trade. That's how we look to open any new position. Now, could I get a cheaper price if I bought, let's say, the 4th of November 115 put for only maybe $3 at that time, maybe $4? Of course, but using a put for insurance, and it's not just insurance, and we'll get to that later, but using a put for insurance, you get what you pay for. By purchasing the put the way we structure it, at least 150 days out in time, and looking for a range in the money to keep our risk between, let's say, a 3 to 7% range or 3 to 8% range, that allows us to force an ideal size trade. By buying further out in time, we avoid the rapid time decay that you would see by buying a cheap October option, November option, or even a December option. And going slightly in the money means we guarantee ourselves a higher payout. But we also pay less time premium compared to the at-the-money option, if we just bought the 114 put, for example. Well, what we're here to talk about today is market indecision. Okay, and first, before we get into that, I just want curiosity here. I want to know what types of option strategies are most of you trading right now? Are you mainly just looking at stock or ETF purchase only and managing those positions, maybe collecting dividends? Are you focused your portfolio mainly on covered calls and naked puts, looking to generate maybe 1 to 2% on a weekly or monthly basis? Do you mostly buy calls or puts, speculating on a market movement, one direction or the other? Or perhaps you're doing straddles and strangles, especially right now during earnings season. Are you looking to do credit spreads, bear call credits, bull put credits and so forth, maybe debit spreads or condors? Or are you doing different types of diagonal spreads or combinations? All right, so we've had the poll open for about 50 seconds here. I'm going to leave it open for another 10-15 seconds. About 60% of you have voted. Okay, so I'm going to leave the poll open for about another 5, 4, 3, 2, 1. Kind of interesting. I kind of figured we'd have a savvy audience today, and that's great. But let me go ahead and close the poll and share the results with everyone. No one is mainly looking at just stocks or ETFs only, just buy and hold, buy and hope, as we sometimes call it. 22% of you are doing covered calls and naked puts. 44% of you are buying calls and buying puts. Okay, that's fantastic. And about 33% of you are doing the credit spreads. All right, so let's go ahead and hide those results, and let's talk about now, what do we do when a position is profitable? Okay, whether it's a stock, or maybe you have a long call that's moved up in price. Maybe you have a covered call position where you're expecting to make a 2 or 3% yield and the stock has moved up. You could liquidate early, perhaps, for maybe a 1.5 or 2% gain, about 50 to 60% of what you expected to make. Or you have a spread trade that's close to maybe 70 or 65% of what you expected to make. Now, what are some of the ways you might look to manage these positions? Well, there's a variety. For just the stock or the long call, would you look to close half or part of the trade, leave the rest of it open, helping to reduce your cost basis? Do you maybe just liquidate the trade, take the profit, and move on? If you've got a stock, a long call, or a covered call, would you sell a call against the position or roll the covered call up in price to try to get a higher premium? Would you add more for further upside? If I had a long call and it went up, maybe I'd ladder the position, is sometimes what it's called. If I bought a 100 call and my stock moved up to 110, I might now buy a 105 or a 110 call, and if it moves up again, I might buy the 115. Or are we of that thought that we do nothing, hope the position goes up, but maybe see the position continue to reverse against us and end up in a losing trade? Well, let's just launch a second poll here. It'll be the last poll for about another 45 minutes into our presentation. But what was your approach? Think about it. If you had a stock, if you had a long call maybe, or even a covered call, would you liquidate the stock or the position take the profit? Would you sell half of the position to reduce the cost basis? Would you sell a call at a higher strike or maybe roll your covered call position? Would you add more shares or contracts, maybe doubling the price there or doubling your number of shares, your number of holdings? Or would we consider doing nothing on the position, hoping that it continues up, but not looking to add to the cost basis, but keeping our maybe original position, the 100 shares, or let's say the 10 contracts of the call in place at the same time? Okay, now, well, this is pretty much what I expected. As again, we saw that most of you are a pretty savvy audience here. The last time I did this poll a couple presentations ago, we did have about 15% of the audience said that they did nothing. In the case when they had a long stock that's up in price, they do nothing, just expecting the stock to continue to move up as well. All right. Well, I've had the poll open for about a minute, and we kind of want to move on here. So let me close there, and let me share the results with all of you. All right. Well, 11% of you would say that you would liquidate the position and take the profit and then look for another profitable position to enter later on. About 44% of you said that you're going to sell half of the position to reduce the cost basis and hold on to the remaining. That can work out very well. And 44% of you are going to look to roll maybe that covered call, or you're going to sell a call at a higher strike to reduce the cost basis, stay in the trade as well. No one said they'd add more shares or contracts. Okay, that can work out long term, but we probably don't want to put more money into the position. And again, pretty savvy audience, no one said that they would do nothing. When we had a small gain or a reasonable gain in the position, we're going to look to manage it one way or the other. All right. So there are many trades, there are many ways. Let's be honest, it sounds kind of silly, it sounds kind of stupid, but having a gain on a position can be frustrating. We should be lucky every time, but it's almost as frustrating, in fact it can be more frustrating, having a gain on a position than having a loss, because we're faced with several different ways that we could potentially adjust, potentially manage, and of course potentially miss out due to our market indecision. When we have a loss on a position, hopefully we don't think ourselves we had our trading plan in place, and if our covered call position that we generated maybe 3% dropped down 7%, maybe we'd look to liquidate the position if the stock fell 7% from where we entered it. Or of course, maybe if we had a sudden gap down in price, we'd look to manage our spread trades before the position went in the money. Now earlier I showed a radioactive position that might have been opened on September 28th with the stock trading at about 113.95 a few days ago. But let's go back in time and take a look at Apple on September 9th. In the closing on September 9th, Apple was trading at 103.13 following a pullback of about 239. In fact, most of the markets were down at that time period. It was a little drop in the value there during that day. Now, it says here yesterday's close, but let's take a look at the chart for Apple. Here, highlighted in red, we have that close at around 103.13. And then we see, of course, that it rebounded and it recovered, went up kind of like the rest of the market did over the next 19 days, 20 days or so, to where at the close on September 28th, it's at 113.95. Well, if we saw the pullback on Apple, we thought the market was still strong. And we entered the position at 103.13, or maybe you entered a covered call, or maybe you entered a long call at that time. Well, on the stock itself, you had a gain of 1082 for about a 20-day trade, or 10.5%. Of course, as I mentioned here, the indexes as well showed kind of a similar decline. Here was that drop we had on September 9th, and then it sort of recovered. Now, it only recovered about 2.1% as of September 28th, but you know, the rising tide sort of lifts all boats. But we have Apple here potentially sitting at a gain of 10.5% if we had bought in at the pullback or done another different strategy. Now, here, and today the stock's right about the same price. It was about at 113.75 at about 10:15 a.m. Eastern Time today. But now we enter the market indecision. Looking on September 28th, we have an unrealized gain of 10.5% in the underlying. Or if you did a bull put, you're probably close to a 75 or 80% gain. And if you had a long call, Maybe you bought the 105 call when the stock was trading at 103. You're probably looking at a leveraged gain that was really high in maybe the 60 or 70% range. But here comes the indecision. Do we close now and take the gain on the position? Do we close half of our current holding to reduce the cost basis and leave the remainder open? Do we convert the long shares or maybe roll the covered call? It would have cost us money if we'd opened the covered call to begin with. Okay, but we still could have maybe realized a further upside profit. Do we add more for the further upside? No one said they would do that. Or do we do nothing or maybe something else? All right, well, let's take a look here. Looking at that chart we saw for SPX, and of course what we've seen over the past few months, we could say that the market is overbought and due for a correction. Or of course we could say that the market's going to continue up. The other things that we know about this potential position is that Apple has earnings coming up on 10/27, about 30 days away. And also, if we were in the stock position, the ex-dividend date is coming up at around 11/4. Okay, so about 35 days away as well. So we have a potential for an earnings pop. We have a potential for a dividend. So let's take a look at each of our choices. We could sell to close Apple around 114, as we were talking about with the stock at around 113.95 on September 28th, about 113.75 earlier this morning as well. We would realize the 10.5% gain, and that's a fantastic return for a 20-day trade. But unless, of course, we buy back in, we miss any more potential upside for the earnings or the dividend coming out as well. But we've taken our profit, about $1,000, be $10.87 per share. For 100 shares, you make $1,087. We're out of the position, and we could look for more. Now, taking a look at the other side, if we had purchased 100 shares at 103.13, we'd have $10,313 invested. If we sold to close 50 shares at 114, we would take in a value of $5,700. So the cost basis on our remaining 50 shares would be about $46.13. So we would have lowered our cost basis on the stock to $92.26, more than we could get for selling a call at any time. If we had opened it originally, of course, at 103 and sold the 105 call, might have collected $2, but as the stock moved up to 113, we might be paying close to $10 to buy that back and getting $3 to the 115. So we're looking to lock in a higher gain by rolling that covered call, but we would have added to the cost basis. Here we've reduced it drastically down to $92.26. And of course, if earnings go up, we can still realize more profit on our 50 shares. But if earnings disappoint and the stock falls to 95, or maybe $90 per share, which we saw about 2 earnings ago on Apple, is about a 17-18% drop, we're not going to be able to get as much profit on the remaining shares we have in our account. Okay, so that's the potential we know going forward into October 27th. Now, talking about selling a call to reduce the cost basis and potentially lock in higher gains. We bought our shares of Apple at 103.13. We could sell to open on September 28th, or even close today. It'd be about $2.70, I think I saw it, but close to $3. So we could sell to open the 28th October 115 call at $3. This would be for the day after earnings, and the reason I chose this one is this particular series, the 28th of October, is the most affected by the volatility increase so far, and it'll probably increase further as we go forward and get closer to the earnings date on October 27th. But we take in the $3 premium. We'd reduce our cost basis to $100.13. That would be our new break even. And if we get assigned at 115, we'll make a profit of $14.87, or roughly 14.9% against our original, or I should say our new, cost basis on the position. So that is a hefty, hefty profit to expect. We've outpaced the 10.5% of liquidating the position now. We've didn't lower our cost basis as much as we could by selling half of the position, but we are looking at potentially 50% more of what we get than liquidating right now. Instead of 10.5%, we could make about 14.9, almost 50% higher. But there's nothing more that we can get beyond 115 without rolling the call if the stock spikes up, and this 14.9% profit is not guaranteed. That would only be if the shares were trading above 115 on October 28th, the expiration day. Okay, now I'll just go through this quickly. No one said that they'd add more shares, but we'll just talk about it briefly. Laddering up with a long call position or laddering up with a stock, and you might not even have added an extra 100 shares. Remember, our original 100 shares is at 103.13. If we add an additional 100 at around $114, that 113.95 we saw on September 28th, our new cost basis per share would be 108.56, and that's for 200 shares of stock. Now, if the stock did go up to 115, where we'd make that maximum profit we just saw of 14.9% on the covered call position, the profit for our 200 shares would be 1,288. Because remember, we increased our cost basis. So from 108.56 to 115, it'd be just a gain of 644. But here we are, of course, we have 200 shares, it'd be 1,288, but that's only 5.9%. It's about a third of the covered call, a little more than half of liquidating now, but we're still in the position and the upside is still open. But by increasing the cost basis, we've actually increased risk to the downside, which we don't want to do. And of course, we don't need to go through this, but if we do nothing, we have not reduced the cost basis. We haven't added to the cost basis if we do nothing. We keep the risk and break even the same. All right, so let's look at what we would expect with those potential 5 adjustments at this point, holding a stock position that has a gain in it, or potentially, you're looking at a covered call and you can think of rolling the call, but you're going to have to pay more into it to do it. And if you have a long call, it would come out to be similar numbers as far as this goes. So let's talk first about liquidating the position. On September 28th, or on today, if we liquidated our 100 shares of Apple that we got at 103.13, well, we have no cost basis left in the position. Well, the profit continues to go up on October 28th, not October 29th, but October 28th after the earnings. You've locked in a 10.5% gain across the board. Don't have to worry about any potential losses going forward or anything along those lines. If we chose to sell half, and 44% of you said that you'd sell half of the position, you drastically reduce your cost basis to 92.26. Now, if the stock was at 115, you'd have a profit of $1,137 or 24.6%. We've added some leverage into this because we reduced our cost basis so much and we're holding 50 shares. And of course, if the stock moved up to 120 after the earnings, about 5-6 points from where it is right now, 5 or 6% gain, you'd have a profit of $13.87 monetarily, or 30% against your cost basis, remember, of $46.13, 50 shares at $92.26. Now, if everything goes against us, if we were bullish on the position, that's why we would have stayed in by selling half, okay? But if earnings disappoint and the stock drops down from 114 to 95 on October 29th, we'd still have a gain of 137 or 2.9%. So selling half here so far gives us a good leverage return, and we'd still have a profit if the opposite happens or an unexpected event happens as well. Now, if we sell our covered call, the 115 call for $3, we reduce our cost to $100.13 per share. Remember, if the stock's trading at 115, we'd get our max profit of $14.87 or 14.9%. Again, it's about 50% more than what we'd get for liquidating right now. And if the stock goes up to 120, 125, 130 or more, well, we still make $14.87 or 14.9%. Of course, if the opposite happens and the stock falls down to 95, well, it's pretty simple. We had a cost basis of 113. Our short call would expire worthless. We've had a loss about 5.1% on the position. Now, no one said you'd do these last two, but I still want to show them as potentially a comparison. Jumping to the last one first, if we do nothing, we keep our cost basis exactly the same. If the stock was at 115 and we stayed in, got lucky, well, we'd have more profit than we would have had by liquidating right now, but not as much as the covered call. Monetarily, we'd have more than selling half, but not percentage-wise. And of course, if it goes up to 120, we have higher profits than all of the positions, both, well, monetarily we have higher profits than the covered call, of course, or selling half, but the percentage isn't the same. But because we didn't sell the call, we didn't reduce our cost basis. If the stock pulls back to 95, we're still at a loss of 813, or about 7.8%. And if you added more, well, you're going to increase your cost basis, and what does that mean? Well, that means you're going to see high profits monetarily, especially if the stock continues to move up, but percentage-wise, it's just going to be about even because we've got more invested in the position, and it also means we're going to risk more as well. So I'm actually very happy that many of you, no one said, I'm sorry, that they would add more into the position. I know a lot of call investors and even some stock investors will have this idea of laddering the position and continuing it to move up. I think there are better ways to manage both a long call and a long stock position rather than adding more in, increasing your risk if you're wrong. Notice how I'm not even talking about stop orders here as a way to manage or using a trailing stop. Why? Well, if I decided to do any of these last four positions, selling half, doing the covered call, buying more, or doing nothing, it's because I had planned to stay into the position, possibly through earnings, to see if I get that extra pop. And what do we know about trailing stops and stop orders? Well, they're just a market order, essentially, that you tell your broker, hey, if the stock ever hits this point, close me out of the position. Meaning that now with the stock at about 114, if I held on to the shares, or even if I sold half, took my cost basis down to 92.26, but if I put a stop at 110 and we hit earnings and the stock gaps down to 95, the stop order is irrelevant. The trailing stop's irrelevant. What essentially happened is I'm in a market order that says I wanted you to close out my position if the stock was trading at 110 or below. Well, the market opens at 95. That market order is triggered and your broker says he's got to close it, but the only price they can get you is 95, 94.90, 94.80. That's assumed insurance. Okay, now you could still, of course, add the stop to these positions, but if you're planning on staying in through expiration, if you're planning on staying in through the earnings date, if the stock did hit this last point, it did drop down to 95 due to poor earnings, stop order is not going to help you. You're still going to realize that 5% loss on the covered call, the 12.4% loss, only have a 2.9% gain, which is pretty respectable considering the stock's down about 20% from when we sold half, right? Or the loss of 8%. Okay, now let's talk about another idea. The radioactive trading techniques don't only help you protect a position, of course, if you're opening it from scratch, but they can also help protect and lock in gains at a small fraction of the cost that you might pay for adding more shares or doing other positions. I apologize here. I think the next slide's a little wonky there, but just notice that ahead of time. But anyway, remember we bought 100 shares of stock, 103.13 on September 9th. Unrealized gain of 10.5%. On September 28th, we could have liquidated to take in the 10.5% gain. We could have sold half to reduce our cost base, so we could have done a covered call. We could also choose to buy the 4th of November 115 put at 450. So I'm going to add another $450 cost basis into the position. This would take us up to 107.63. Now, I mentioned it's lower. And what I mean by this here is that this particular value, the 107.63, is lower than if we ended up buying more on the position. Okay? It's not as low as the covered call. It's not as low as selling half. Okay, so we are increasing our cost basis up to 107.63. But remember, unlike a stop order, by purchasing the put, I now have a guaranteed exit of 115. So my total cost into the position is 107.63. In the worst case scenario, I'm guaranteed to get 115 back, which means we have a locked-in profit of 737 or 6.8%. So I have an unrealized gain right now of 10.5%, and by adding this guaranteed stop order, paying 450 to be guaranteed exit of 115, we've locked in about 68% of our unrealized profit. But the upside profit is still unlimited. Even if the stock fell after earnings on October 27th, down to $95 per share, 92 or even lower, which I wouldn't expect, but it could happen, I'm still guaranteed a profit of 6.8%. Okay, now, Vicky, I'm going to talk about that in just a moment, of course. Vicky brings up a great point. Why November 4th? I thought you said 150 days or more out in time, and you're absolutely right. When I open a new position, I'm illustrating this as the 4th of November because it allows me to cross both examples that we were talking about with our other situations. Why would I have stayed into the position by selling half and keeping the rest Vicky, or why would I have done the covered call out to October 28th? And it's because I wanted to go through the earnings and perhaps the ex-dividend date if I was holding the shares of stock. So by buying the November 4th, 15 one, we're just using that as an illustration how that could lock in the profit through earnings, 68% of the liquidized gain I could take right now, and still be able to take advantage of the dividend going forward and still locking in 68% of that potential profit. Okay, but you're one step ahead of me. We're going to show that example as well, Vicky, in just a moment. Sometimes I hate slide presentations. Oh, no, it came out perfect. I'm sorry. My apologies. The preview was showing me a bunch of extra lines and dots that were in here. But anyway, how would that chart look right now? Owning shares of stock at 103.13 with an unrealized gain of 10.5%. And then purchasing the 4th of November 115 put at 450. Now we see that gain, that no matter what happens, we have a guaranteed profit of 6.8%, and we still can take advantage if the stock moves up to 120, 118, or even further, unlimited upside profit potential. Are we taking in the 10.5% gain right now? No. We've taken in about 65, 68% of our unrealized gain while still leaving the upside open. Okay. Now, a proper structure. This puts us in a position where we have a proper structure to stack the market odds in our favor. We can go forward through the earnings or through whatever the stock does for the next 30 days before the earnings without fear. We have no fear of overnight drops, no fear of a market correction, and it's a guaranteed exit rather than assumed insurance that we'd get from trying to use a stop order. We have the confidence and comfort going forward. We can sleep with ease going into any event. Now you have a guaranteed profit to the downside. Okay, you win if the stock loses, but you win more if the stock wins as well. So that's stacking the market odds in your favor. Now, what we saw, for those of you doing the covered calls, well, I don't just have to put the put on there and leave it alone. We could increase our guaranteed payout absolutely and profit both directions, of course, by still selling that same call. Now that I've bought the 115 put and locked in a potential profit on the position, we could simply sell that 115 call to create a collar where now my guaranteed exit to the downside, if the stock collapses down to 95 or even $90 per share, we have a guaranteed profit of about 10%, pretty close to what we get with liquidating the position. And if the stock's trading around 115, we could make a little bit more than that 10.5%. And of course, if the stock gaps up to 120 or 125, we're still realizing close to that 10% profit. Now, this does cap our game. That's the downfall of selling a call just to reduce the risk. Okay? But you could still do that in the context once you've locked in your unrealized profit on a position and continue to go forward through the earnings event, you can continue to use other adjustments there. Oh, sorry, there we go. All right. So let's review one more time, comparing and contrasting what would it look like with our other option here of locking in the profit, entering into the radioactive trade. Well, we do increase our cost basis, less than what we did if we bought more shares. And if the stock was trading at 115, we'd realize a profit of around 8.5%. More than buying more, less than selling half right now, or less than the covered call, of course, if the stock was at 115. But if the stock continued to move up because of that earnings pop, we wouldn't have a capped gain, so we could still make pretty much close to what we'd have on the covered call. We'd have a higher profit than liquidating right now, about the same monetary amount of selling half, and more profit than, of course, buying more as well. Now, remember, if the stock fell, if it dropped to 95, well, we would have a reasonable gain of 2.9% by selling half, but we could lock in almost a 7% gain by just adding the put option, even if the stock gapped down to $95, 737 or 6.8%, rounded up to 740 or 6.9%. So if it fell to 95, we've locked in 7% while still having the potential to realize that 10% or higher gain. And of course, if you did the covered call, we're going to beat the do nothing, right? If we bought that November 4th put and sold the October 28th 115 call to generate the $3, reasonable cost basis of 104.63, not as low as selling half and not as low as the covered call, but we'd do about 1% higher if the stock was at 115 and liquidating right now. Gives us a better option, okay, to realize further profit if we're right, but still controlling that loss. So if the stock fell to 95 or pulled back, we'd have a 10% gain rather than an 8% loss, 12.4% loss, or a 5% loss as well. So that's what we can look at to another option, which we prefer to do here, to use a put option to lock in the potential gains. Now, looking at the comparison here, naturally, those of you who are thinking of selling a covered call, you would reduce the risk on that position if you had a gain. You'd have the potential for 50% more profit than just liquidating right away, and you'd have a small loss if it reversed against you. But you've capped your upside, and there's nothing wrong with a 14.9% gain. But if the stock continues to move up, 125, 130, we're going to see all of these increase with the exception of the covered call position. And of course, the radioactive with the covered call as well would be capped at about a 10% gain if it really went up high. Now, selling half gives you a great leverage position. You can still earn a good monetary profit, and of course, you were the only one at the time, before we discussed adding the put option, where you could still have a profit to the downside. But here, we can lock in as much as 3 times or almost 4 times the amount of profit on the position by just adding a little bit to the cost basis and not taking much away for the potential gain if the stock continues to move up in price. Okay? And of course, you know, someone had mentioned, well, what about the long calls? It's the same principles. You'd see the same kind of monetary adjustments. If you had a long call that moved up in price, you could sell half of it, leave the rest open if you bought 10 contracts. You could sell a call against it to create a calendar spread. You know you'd have a capped gain. You would still potentially have a loss if it fell against you. You know the result if you did nothing. You could still structure a put against that call position going into earnings to create a strangle, essentially, that could be bulletproof and have no risk. We can do that synthetically as well. All right, now let's talk about where Vicky wanted to go. A little while ago, Vicky asked, well, I thought you said that you were going to look for positions that were at least 150 days out in time. You're right. If I was looking to open a new position at the time, if I just had stock or long call perhaps, and I had an unrealized gain in the position, I was looking to manage it, I would have gone to the insurance tool on the Fusion subscription at Radioactive Trading or on Power Options, put in my prices and see which puts I could buy to lock in that unrealized profit. I would have decided which one would have been best for me based on my expectations of the stock going forward, and of course, what I'm looking to accomplish. But I just put in the one for November 4th, Vicky, because we just wanted to show what it would lock in crossing the earnings event and still being able to take advantage of the ex-dividend with that roughly 7%, 6.8% locked in profit of the 10.5% unrealized. But let's go back to September 9th. What if I was going to open a radioactive trade for Apple on September 9th when the stock was trading at 103.13? I would have gone out a minimum of 150 days. So here's the February series for our positions. And remember, I mentioned that you get what you pay for. When I open a radioactive trade, I'm typically kind of in this range as far as risk goes. I want to keep my risk to be between, let's say, maybe 3.5% to about 8%. So the put options that match the range and the risk threshold that I'd want to look for, still going 160 days out in time, our February 110 put, we priced at 11.25. So that would be a cost basis of 114.38. We're guaranteed 110 back, so our risk would be 438 or 3.8%. The 105 put costs 815. So this put my cost basis, buying the shares, buying the put, 111.28. Guaranteed to get 105 back, so my max risk is 628 or 5.6%. And then of course the February 100, much lower price at 570, but remember we get what we pay for. We're only guaranteed to get 100 back, so we'd have a risk of 883 or 8.1%. Now I could buy the cheap put, February 90 at 258, but now that risk keeps me 15% of the position. Okay, so again, you get what you pay for. If you want to buy a cheap option that's out of the money, gives you a lower guaranteed exit, well, you might be risking the double-digit ranges, is what we try to avoid to properly stack the market odds in our favor by keeping our risk in that 3 to 8% range. So my targets would be here, and for this example, I'm going to stick with the slightly in the money at the time 105 put for a price of 815, which would keep my risk at 5.6%. Okay, so what we call the 5-line setup, here's what we'd be seeing. We'd buy shares of Apple at 103.13, the February 105 put at 815, so my total cost per 100 shares, cost per share, would be 111.28. Now that is the highest cost basis of our comparisons, isn't it? Remember, if we added another 100 shares to our unrealized gain, we would have had a cost basis of 108.56. If after the stock moved up to 113.95, we showed that 4th November put that we could buy at 450, the 115 strike, so our cost basis would have been up to 107. So at the time on September 9th, this would have been a higher cost basis. But remember, we're guaranteed to get 105 back, so the most we could lose is that 628, or 5.6%. Again, we see the standard profit and loss chart of our position, and I want to remind you that remember that maximum loss for the February put that was 161 days out in time really only occurs if I hold the position all the way to February expiration. I choose to make no adjustments and accept no dividends between now and February expiration, and Apple was trading below 105. Or if tomorrow the stock had a 50% decrease in value, suddenly dropped down to $61 per share, right, maybe in that case I would be as well. But we don't think that's going to happen. Anything can happen, which is why we trade this way to begin with. But this is how I would have opened the radioactive trade on September 9th. Now, of course, remember what we saw over that time period Apple did. If I had entered a covered call here 2 or 3 days later when the stock was at 112, would have had to pay to roll that call and increase my cost basis, and then maybe done it again here right around, let's say, September 14th or 15th. And then, of course, right now I'd still be in a position, but may have had to roll it twice to try to take higher advantage of further upside potential profit. All right. Now, what can we do? We talked about how when we structure the trade properly, by purchasing the put further out in time, we don't see rapid time decay on our position. At the same time, we've put ourselves in a position where we don't just have insurance on our stock in case something falls or goes one direction or the other. The put is actually a working asset that we can use to manipulate time value, which those of you trading credit spreads and those of you trading the covered call positions as well, and those of you buying calls and buying puts, you know that the time value is really the true profit for those of you that are selling, and the time value works against us the most when we buy calls, unless we have a, sharp decline. But on September 13th, on that first move that we saw, Apple was around 107.95. This is about a 5% gain on our position. We had 1128 into our radioactive trade, the 103.13 for the stock and I'm sorry, 815 for the put option. Now on September 13th, I could sell to close that February 105 put for 570. This is what I'm talking about in regards to the put being a second asset. So one of the 12 ways we might look to adjust this position as the stock moves up in price, or it stagnates, or it falls. We got into the 105 put when the stock was at 103. Okay? Now the stock's at 107, so our 105 put is out of the money, but it still has $5.70 of extrinsic value or time premium because we still have about 150 days left to expiration in February. Now, we did pay $815 for that put originally, and we could sell to close it now for $570, so we're losing $245 on the put. But the stock has moved up $4.80 roughly from our purchase price of 103.13, and we own both assets. So we still have a positive delta, and we still have a positive gain on the position. But this 570, when we got into the position, the maximum risk there, let me go back one real quick. The maximum risk on that married put was 628, or 5.6%. Of this 815, of course, $1.87 was intrinsic value to 105, which we're guaranteed to get back. So the remaining 628 is the time value, or the true risk on the position. Even though we've been in the position for a few days and the stock has moved up, we still have 570 of extrinsic value, which we're going to use to manipulate. We're going to sell to close our original put at 570 and buy to open a higher strike put, move up to the 110 for $8. So this transaction, when we call them income methods, this is the one transaction that is done at a debit. I'm paying $2.30 to make this adjustment. It will add $2.30 to my cost basis, so it'll now go up to $113.58. But we've guaranteed ourselves a higher payout, $110. So now the max risk on the position is lowered down to $3.58, or 3.2% from that 5.6% we started off with. Now remember, I paid to $2.30 debit, but that was to guarantee a higher payout of 5 points. So we pretty much reduced this risk by $2.70, right? From the 628 down to 358 based on the debit to the difference in strike price range. This is what we call income method number 4, rolling the put up to lock in a higher gain. Okay, so as we continue to move forward now, we know the stock's at 107.95, and we saw that other gap, and a few days later, Apple was trading at about 114. Well, here's the new profit and loss chart. What are we doing here as we adjusted the put? We did add to the cost basis. It's still higher than the other cost basis that we've had, but now we only have a risk of 3.2%. We're lowering this gap between the floor of the position and the maximum risk. And this curved red line at the halfway point is getting less and less steep. We're going to be able to realize a profit sooner because now that we've moved this put up to a higher strike price, it's still going to retain most of that value. Right? It's not going to suffer the rapid time decay if I had bought an October 15th or an October 28th put option against it. Now again, we saw it keep going up. So let's go back to where we were on September 15th, or even today, had we had that position with the stock at around 114, 113.50 or so. But on September 15th, Apple was trading at 115.57. I could look to manipulate that time value again. Let's go back one. The stock was at 107.95. We took out the extrinsic value of the put that we had already accounted for, but at the time the 110 put was at $8, right? Well, this is $205 in the money. We're looking at a 110 put when the stock was trading at 107.95. So we're guaranteed to get $205 back. So our time value on this put was $5.95. Now, a few days later, the stock goes up to 115.57, and we can sell to close the 110 put for 510. We still have $5.10 of extrinsic value remaining. It didn't go to zero, even though now the put is out of the money. Well, once again, we're going to manipulate that. We could sell to close that to bring our cost basis back down to 108, and then buy a 115 put at 725. Now the cost in the position total is 115.73. We've added to the cost basis, but look, we are guaranteed now to get 115 back. Again, I paid another debit here of about $2.15 to guarantee a 5-point higher payout. So now, having opened this position on September 9th, potentially as a new position, rather than locking in the profit before, but even had I done this as a radioactive trade on the Fusion subscription where investors and subscribers can follow Ernie's radioactive trades, mine and Greg's, we've increased our cost basis, yes, but guaranteed a higher payout. So now going into earnings, or perhaps the ex-dividend date, we're continuing to shrink this red water. We're practically bulletproof on the position, meaning where we'd have that place where we have no risk and a guaranteed profit. Now, what else do we know about this? Well, there's other adjustments I could use at any given time. I could sell the October 21st or maybe the October 14th 115 call to easily get $1.50 or almost $2 to completely bulletproof the trade before the earnings. As we saw before, though, that would take the risk where we'd have that capped gain. So if it did continue to move up to 116 or 117 prior to the earnings, we would have to roll that. But unlike the covered call, which could still have a loss if the stock fell to 95, that would have locked in our profit on the position, and we would be bulletproof as well. So whether we opened it as a new position on September 9th, starting it off with a locked-in profit, where some of you might have said that looked really expensive. You originally added $8 onto the position, and you put your cost basis well above what it was for the other adjustments had we just bought the stock and held it and then looked to adjust afterwards. But even if we'd opened at a new position, following the various adjustments, we can go into earnings now and the ex-dividend date with a pretty much no-risk position, and we could do other adjustments to bulletproof this position completely and still leave the upside open, doing some of the riskless spread trades, the other 12 income methods that we use at radioactive trading. So even starting from scratch, Vicky, as I mentioned, that's how I would have done it on September 9th. And now, yes, did I increase my cost basis? Of course. And does that mean that I don't have a profit right now? No. With the cost I have into this position, after moving the put up, pretty much getting to a bulletproof position where we have no risk and still have infinite upside, well, you can see the prices, today, if the stock was at where it was 113.50, that put is still around, this put that we just paid $7.25 for is still around about $6 or so. So we could still take in about 119, 120 from our cost basis of 115. So we'd have a profit of about 4.5% to about 5%. Okay, not as high as what we did if we just liquidated the position. Not as high as if we had sold half if we hadn't done the put option from the beginning. But at the same time, here going forward to earnings, we're almost bulletproof on the position, pretty much have no risk, and we still have infinite upside going forward. And notice, as I mentioned, as we continue to adjust this option, this curved red line, the halfway point, starts to get less and less steep. We're increasing the profit there while canceling the risk, the red water, down here. All right, that's the advantage of using the put option as an insurance policy on your stock, because it's not just an insurance policy, it is a second ownership. It is a second asset that you can manipulate in addition to generating premium by just selling calls or by doing what we call riskless spread trades that would normally take on risk in a portfolio, but done in the proper context, can still generate income and actually lower the initial at risk on your position and not increase it by using leverage spread trades and even ratio call spreads against the position. All right, so that is our thoughts. That is our approach on how we prefer to remove market indecision. Whether I have a realized gain on a stock, perhaps a real unrealized gain on a covered call, we could add the put option to the existing covered call, but I may want to manage the short strike price first to give myself more upside, then add a put option to lock in the remaining unrealized gain, or at least part of it. And of course, if you have a long call that's moved up in price, you could evaluate it the same way. Look to buy a put option in that scenario, sort of create a bulletproof strangle, which we can do synthetically in this case as well. That's how we like to remove market indecision here at Radioactive Trading and Power Options. It allows you to go forward trading with a safety net. Even from the beginning, I knew that if I was wrong on Apple, and from September 9th to September 28th, if we'd have got in at 103 and bought the February 105 put, had the stock fallen to 95 and then down to 92, I knew that I couldn't lose more than 5.6%. And that again is the worst case scenario. If we had entered Apple as the radioactive trade, starting on September 9th with the stock at 103, bought the 105 put for $8, if the stock fell to $92 on September 28th or today, well, I would have gained intrinsically on the put, and it still would have some time value. That 105 put, if the stock was at 95, would not have gone to just $10. It'd be worth about $12. So I'd still take a loss of maybe 2.5% or maybe 3%, but I wasn't near the max loss of 5.6% yet. That would only happen at February expiration, or if the stock fell by more than 50% or so. You've no fear of earnings, no fear of a black swan. You know, how many of you have gone forward with a covered call position and maybe 5 days or 10 days before earnings, you don't know whether you should buy the call back to allow yourself further upside, or if you should roll the call down to protect against further downside, which means if it gaps up, you're still going to get assigned at the lower strike price, maybe not make as much. Add a cheap put, only to have it not drop far enough down to your put strike price to where it locked in any gains, and you add it to your cost basis. Okay? We can't predict the future. I have no idea what Apple's going to do on October 27th at earnings. I have no idea what Apple's going to do between now and Thursday. Okay? But you can trade like you have a crystal ball. Adding the put or even rolling up the put as the stock had moved up, or just adding the put now, I don't know if this 115.57 on September 15th was the highest that Apple was going to be. I don't know that. I just know that by using the put, I can guarantee that I've locked in most of that profit that I would have had if I liquidated the position. And I can still realize further upside. So if it goes down, I've locked in, maybe we saw about 68% of liquidating the position, but if it moves up, we can realize more than that 10.5% going forward. Okay, now think about the original setup that we showed you. If I had opened it as a radioactive trade on September 9th with that risk of 5.6%. And I just want to think about your trades from last year. If you had opened the position as a radioactive, if you opened all your positions as a radioactive trade, and you limited all of your risks, a guaranteed exit of no more than 5% on any position you opened last year, how would your portfolio would have looked? Would keeping your risk to less than 6% not have helped your portfolio at all? If you lost last year, would you still have lost, but lost much less? And if you had a losing year last year, if you'd kept all of your losses to a guaranteed exit of only 5 or 6% no matter what happened, might that have turned a losing year into a winning year? All right, so I've had the poll open for about a minute. I'll leave it open for another 10 seconds. We have about 50% of our audience has voted in. Okay, so let's go ahead now. More votes coming in. It's an even split, bouncing back and forth. All right, I'm going to go ahead. Okay, still battling through here. Okay, so let me go ahead and close the poll now. Let me share the results with everyone. All right, 36% of you, of course, said that you would have lost, but you might have lost much less. You'd still have more in your portfolio to continue trading. 64% of you said that that would have turned a losing year into a winning year by just keeping your risk controlled. to 5 or 6%, guaranteed, not like a stop order, not like a trailing stop, 64% of you would have had a game changer. You would have turned a losing year into a winning year. And nobody said that having the ability to keep their losses to less than 6% or to potentially lock in an unrealized profit rather than closing out and, hey, maybe taking that 10.5% gain, but if the stock continued to move up, you missed out on 15, 20, 25% or more. Well, if you would have locked in the gain and still would have been able to realize that further upside, I don't think anyone would have said that wouldn't have helped you as well. All right, so that's pretty much what I wanted to share with you today, a different alternative to potentially managing a position that you have a small gain. Now, for those of you, of course, that are doing other strategies, you want to know maybe what are the ways to manipulate a credit spread. I think 44% of you said that you're doing, I apologize, 33% of you said that you're doing credit spreads and so forth. What you may want to do is I'll send you a link here, is check out the blog. Head on over to blog.radioactivetrading.com. And you're going to see recent articles there that Kurt has put together, such as Don't Fence Me In. He's going to show you a different bulletproof stock story. And can you really do a riskless spread trade? The riskless spread trade I alluded to that I could do on top of that almost bulletproof position on Apple had I opened it as a radioactive trade on September 9th, or that I could do had I just locked in the profit after the stock had moved up as well. And of course, sort of a different view of how this position, how this strategy really stacks the market odds in your favor, the presentation here of giving your trading edge for fun and profit. You can check those out at blog.radioactivetrading.com if you haven't done so already. Okay? And of course, a follow-up. On Thursday at 12 noon Eastern Time, we're going to follow this story. This is why I mentioned I don't know what Apple's going to do by Thursday or on October 27th when earnings come out. But what we're going to talk about on Thursday is we're going to look at where each position stands. Okay, whether we sold half, what we're really going to focus on is what could I do now going forward, wherever the stock is on Thursday, had I locked in the profit on Apple, if we bought the stock at 103.13 on September 9th, and then on September 28th, or today, we had purchased that 115 put with the stock at around 113.50, 113.95, and locked in that 6.8% gain, what other ways could we potentially use to increase that guaranteed profit, but still leave the upside open? Okay, and we're going to also take a look at the position had I opened it on September 9th as the radioactive trade with that February 115 put, and use those two adjustments as the stock moved up to get us to a place where we only had a 0.6% risk. How could I bulletproof that trade, still leave the upside open? Or, in addition to that, how could I go ahead and take that position, bulletproof the position through October earnings, potentially, but be able to profit if the stock falls, if the stock moves up, or have no risk if the stock does nothing as well. That's what we're going to share on Thursday at 12 noon. You can go to radioactivetrading.com, and on the lower right-hand side of radioactivetrading.com, you'll see the upcoming webinars, and you can click there to register for that presentation at Thursday at 12 noon. But don't worry, I'll include a link to register for Thursday's presentation, the follow-up from today, when I send you on email later on this afternoon when today's webinar has been archived and posted to the Radioactive Trading site as well. All right, and we'll post that recording, today's recording, at around 4 p.m. Eastern Time. Now, if you have a question about what we showed today, the radioactive trading techniques, do you have a stock that's up in price? You can send that to us as well. You can send us an email to support@radioactivetrading.com. Remember, you can also call us during market hours at any time. You can reach us at 302-992-7971. Okay, so we'll be available during market hours, myself, Ernie, Greg, but you can also send us an email at any time to support@radioactivetrading.com. So if you do have a stock that's up in price and you're curious about what put options you might be able to use now to lock in those gains as we're heading into earnings season for all stocks, well, send us an email and let us know, and we'll show you the tool we use there on the insurance tool on Power Options and on the Fusion subscription at Radioactive Trading to show you the best way to lock in profit based on your expectations and your goals for the position as well. Well, thank you for joining me today, ladies and gentlemen. I hope you all got some useful information out of the webinar, and I hope to see you coming up soon, Thursday as well. Oh, I'm sorry. Is it Mark? Oh, it's Harry. I'm sorry, Harry. Yeah, Harry says, will Thursday's session be recorded? I have an appointment at that time. Yeah, I'm going to record Thursday's presentation as well, and that will be posted Thursday at about 4 p.m., 4:30 p.m. Eastern Time once the webinar has concluded, Harry. And you'll receive an email for the registration, of course, which you won't be able to attend, but also when that webinar is recorded, just like you'll see when about 4:30 p.m. Eastern Time today when this webinar is recorded as well. So thank you for that, Harry. Yeah, Thursdays will definitely be recorded and available in the archives as well. All right, ladies and gentlemen, thank you very much. Have a fantastic Tuesday, and we look forward to seeing you Thursday afternoon, and I look forward to hearing from you as well via email or via phone. Take care, everyone. We'll talk soon. Happy trading. Good night.